Hi, my name is Stuart Weems and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And today I want to talk about employee share schemes. And whilst you might not be lucky enough to participate in some of these share schemes, it still might be worth listening to the episode just out of general interest perhaps, or if you know anyone that participates in these things, maybe you can recommend the episode to them. But we have seen a huge increase in the number of clients that have benefited from employee share schemes, but they can be quite complex. And, for those that haven't necessarily dealt with them before, they can be a bit confusing in terms of sort of how to navigate them. And so what I wanted to do is sort of talk through that today and go through, the many considerations that you need to think about, also to understand them and think about the tax consequences and all these sorts of things. Okay, so let's get into it. What are they? Well, employees can be granted stock or options in their employer. Typically, if they're listed companies, and quite often these could be internationally listed companies, and it's certainly really common in the tech sector, for instance. So we've had a lot of clients, whether they might be working for Microsoft or Uber or these sorts of businesses. Atlassian is another one, and they get shares in their company. Now, these are often called RSUs, restricted stock units. Obviously, typically the business is traded on an exchange. Now, it could be an unlisted business too. There's nothing stopping unlisted businesses issuing employee shares or granting employee shares. So they could either be shares or options. Options, which are call options, give the holder the right but not the obligation to purchase shares at a specific price called the strike price by a certain time called the expiry date. And so an option just gives you, it's exactly as the name describes, an option to buy stock. Now, normally options would be issued not mainly to really senior executives, kind of C-suite executives, and it's a way of incentivizing people to sort of grow the share price, of course. So if the share price is $2 today, I'll give you an option to buy those shares in 5 years' time at $2.50. And so, if you can grow the share price or have an input to growing the share price to $5, for example, well, you'll get those shares at half price. So that's how kind of options work. Now, I'm just going to talk about RSUs or employee shares options as a generic term. So whether I'm talking about shares or options, they're kind of treated the same. So when do we see clients participate in some of these things? So sign-on incentives. So sometimes, when you join a particular business, they might grant you a certain number of shares as kind of a bit of a sign-on bonus. Often they come with some sort of conditions. So, staying with the company for a set period of time or meeting performance targets. Share grants can come as a result of either short or long-term incentives. So with short-term incentives, they typically constitute a cash bonus, but maybe some of that cash bonus could be paid in terms of granted shares. And certainly long-term incentives, there's typically a component of employee share grants there as a reward for either years of service or meeting individual or company kind of performance goals. And quite often there's restrictions in terms of time when you can sell those shares. So it could be anywhere from 1 year to 5 years or anything like that. And then finally, the third typical situation is share purchase plans. And that's where employees are given the option to buy shares in their company, often using pre-tax salary, so through salary sacrifice arrangements, and they might even be able to buy those shares at a discount. So I'm going to talk about all those sorts of things. Now, vesting is a term that's typically used that talks about when or refers to when a employee will gain full ownership and control over the shares or options that are granted. So for instance, my employer might grant me 2,000 shares, but they haven't vested yet, which means I can't sell them, I can't do anything with them. And the employer might say, Stuart, those 2,000 shares start vesting after 2 years, and they might vest in monthly increments. So after 2 years, every month, 100 of those shares will vest, which means at the end of that 2-year period in 1 month, I'll have 200 shares that are unvested, which means that I could go and sell them on the open market. So quite often vesting is time-based, or it could be linked to achieving certain performance targets. So maybe I'm granted these shares, and when we achieve these certain either company or individual performance targets, that's when the shares vest. Typically, we find it's more time-based rather than performance-based. The initial granting of those shares typically is performance-based, and the vesting then is time-based. Now, if you leave your employer, typically you will forego or forfeit any shares that haven't vested. So, if you're going to depart your company, that could be a negotiation point. If you receive a redundancy, normally companies choose to vest all or some of the shares automatically. So again, if you're getting a redundancy, that could be a negotiation point. And leaving your employer is no longer a taxing point. So that changed back in 2022, whereas when people used to leave their company, that used to be a bit of a taxing point, and you don't need to really worry about that. But if you are looking to move on from your employer, you want to think about how many shares, unvested shares do you have, and what will happen should you move on onto a new employer. Now, from a practical standpoint, managing these shares that have been granted by your employer, they're called what's called issuer sponsored, which means they're managed by the company's share registry. The common registries are like Computer Shares, Link Market Services, Boardroom, rather than through a stockbroker. So when we hold shares, typically we buy them, particularly ETFs and so forth, we buy them through a stockbroker, which means they're broker-sponsored shares. Whereas with employee shares, they're called issuer sponsored, which means they're not sitting on an exchange yet for us to be able to trade those shares. However, those share registries, Computer Share, Link Market Services and so forth, typically provide trading facilities. So, and typically, and particularly large employers will have arrangements for employees to be able to sell shares in a pretty cost-effective manner. But that's something you're going to need to think about when you go and sell them. How are you going to sell them? What brokerage will you pay? Because what you could do with issuer-sponsored shares is you could transfer them to a broker. So, for example, Beta Shares Direct, and this is only for ASX shares, Beta Shares Direct has a platform that has no brokerage, so no fees at all. So you could transfer those shares onto Beta Shares Direct and then go and sell them, and that's going to help you avoid any brokerage fees. But just from a practical standpoint, that's how they kind of work. Okay, let's talk about the tax considerations, because tax is always, a big consideration in lots of these sorts of things. So from a taxation perspective, it depends on whether the scheme, the employee share scheme, is tax deferred or taxed upfront. And the scheme booklet, normally they have, some information that goes along with these share grants, should outline whether it's tax deferred or taxed upfront. Essentially, the classification really depends on whether the shares come with any risk of forfeiture. So that is that if you're not meeting the performance criteria or the time criteria, will you miss out on those shares? Do you have full ownership and control today, for example? So if the shares aren't vesting immediately, its scheme is likely to be tax deferred. In that case, the taxing point is when the shares vest rather than when they're first allocated or granted to you. Now, when the shares vest, the market value of those shares, less any amount that you paid for them, and in most of these circumstances, these shares are granted as long-term incentives, so the amount paid is zero. So the market value of those shares when they vest is included in your taxable income in the financial year that they vest. However, if you sell the shares within 30 days of vesting, the ATO treats the sale proceeds as the taxable amount rather than the market value on the date of vesting. And that can be, a good rule to use to your advantage, which I'll come to in a second. Now, typically options aren't taxed when they vest. Instead, the taxing point usually occurs when you exercise the options. That is that when you actually buy the shares that the options permit you to buy. And at that point, the difference between the exercise price and the market value will be included in your taxable income. And remember, options can be in the money or out of the money. So if the strike price is below the market value of the shares, it's what's called in the money. If the strike price is above the current share price, it's out of the money. Now, once your shares vest, normal capital gains tax rules apply. So if shares vest today and I hold them for 12 months, so in 12 months from today, I then go and sell, or 12 months and 1 day, I then go and sell those shares, I should be eligible for the 50% capital gains tax discount. Now, remember, my cost base from a capital gains tax perspective is the market value when they vested. So I might not be saving a lot of money by holding on to them for 12 months unless there's a lot of capital growth over that period of time. Now, on the other hand, if the scheme doesn't have any restrictions or risk of forfeiture, then it's probably or typically referred to as a taxed upfront plan. And in that case, the taxing point is when the shares or options are granted to you. If the plan is company-wide and meets certain ATO eligibility criteria, and your adjusted taxable income is below $180,000, you can potentially reduce the taxable amount of that share granting by $1,000. So, there is some tax incentives there. Now, if you've got an employee share purchase plan, so that allows employees to buy shares in their employer, typically using pre-tax salary, so through salary sacrifice, often at a discount. The discount typically 5 to 15% is typically the case. If that complies with, again, certain ATO rules, typically it allows you to salary sacrifice up to $5,000 per year without triggering fringe benefit tax. And so essentially allows you to use $5,000 of your pre-tax income, so avoid paying tax on the income, to buy shares. And so you were taxed on the discount. So, if I buy shares for $5,000, but they're really worth $5,500, well, then I'm $500 better off. That's included in my income, but I'm not going to pay tax on the original $5,000 that I salary sacrifice to buy those shares. It's complicated, right? But it's all on the blog on the website if you need to sort of read through it in sort of slower detail. Okay, so they're the tax considerations. Let's get to the financial planning considerations. So if you are granted employee shares, what should you do with them? Now, of course, you don't need to decide until they vest. So if you've been granted shares today and they don't vest for a couple of years, you've got a little bit of time on your side to really think about it. But once they vest, typically there's two main considerations that we think about. Firstly is the concentration risk. As an employee, we are already dependent on this single company and this single industry to pay us an income, a salary income. If we then start accumulating wealth that's tied to this single company, to this single industry, to our mind, that increases the concentration risk and to an unacceptable level. So we typically want to diversify. If we're going to have an income that's paid from this single company in this single sector, let's invest in a way that's not linked to the health of that particular single company and single sector. The second consideration is your view on the future expected returns of those stocks. Now, part of that's going to be dividends and part of that's going to be capital growth. So if you've got a stock that's very high dividend paying and has been, for a long time, then that somewhat reduces the risk because you can kind of, it's not guaranteed, but you can get a good sense of what your future returns are going to be. Versus if it's a growth company, a tech company, it's never paid a dividend, well, then you're really reliant on the share price to continue to climb. Now, I think it's important not to drink the Kool-Aid here. It's you're employed by that business. You obviously, or you might have really positive feelings about it, but it's really important just to be critical and just look at the numbers. So that's things like valuation multiples, what sort of PEs it trading on, how's it valued relative to its peers, what are share analysts recommending, how does the company's financial position look, cash flow, debt, all those sorts of things, industry outlook. All those things go to sort of forming a bit of a picture on, if I hold this stock, does it make an otherwise great investment? I'm just randomly invested now just because of my employment situation. Doesn't necessarily mean that I should be holding my wealth in that company. So our conservative view is our default position is unless we believe the stock is materially undervalued or we have really high conviction about the future upside of the stock, we'll usually recommend divesting. Now, if you're invested or you're lucky enough to receive shares in a company that has, delivered really strong historical returns, that can make it a really challenging decision, right? So if I'm a holder now of a stock that's delivered ridiculous percentage returns over the last 10 years, in some way I'd be telling myself I'd be stupid to sell it, because whilst a growth stock can look expensive today, in 10 years' time, it might look relatively cheap depending on its performance. But again, it's important to stay rational and not get too caught up in the hype. Also, it's not an all or nothing decision. If you are really positive about the stock but acknowledge that it is fully priced, you might sell some, keep some. If you're unsure about the future performance of the stock and think that there's a great probability that it could rise significantly, well, you might still sell some, but sell some in equal tranches every month or every quarter, whatever it might be. It's not an all or nothing decision. It's really just about being tactical, about reducing your exposure to that particular one industry and one company. Now, if you do sell stock, of course, you then got to think about the capital gains tax. And that's if you've held the stock for, a period of time. So if you invested, more than a year or even a couple of years ago, and there's some unrealized gains in there, of course, then you're going to need to consider that factor as well. But also, if you keep the stock, that taxing point is going to be when it vests, and that's going to be included in your taxable income in that financial year. So, of course, there's going to be a tax liability related to the initial vesting of those shares as well. So you need to think about, how you're going to pay for that. And so, most clients will need to sell some shares to pay for some of that tax. Now, you don't need to pay that initially, of course. You might not lodge your tax returns until March or even May the following year. So you've got a bit of time up your sleeve. Having said that, if you do know you need to sell some stock to pay for the tax, you're probably better off to sell those stocks when you make that decision, rather than thinking, I'll sell in 9 months' time, because you don't know what happens over that 9 months and you might look back with a bit of regret not selling sooner. Now, if the stock is listed on an exchange other than the ASX, so if it's listed overseas, that is, you're going to need to then think about foreign exchange risk, just to make it even more complex. Predicting foreign exchange movements in the short term, it's near on impossible. In fact, I would just say it is impossible. There's just too many moving parts, too many moving parts for the overseas currency and our currency, and they're all influenced by, a whole host of really every single macroeconomic factor that you can think about. So it's really difficult. I would instead take a long-term view and have a look at the foreign exchange rate for the company I'm dealing with, whether it's in the UK or the US. Look at the long-term averages. Consider where we are today and where do I think the upside or downside risk is. And again, if you think the exchange is going to move in your favor, well, maybe progressively divest. If you think now is a great time to divest because of the foreign exchange, well, be a bit more aggressive with respect to that. Now, if you decide to keep some or all of those vested shares, remember you are taxed on the market value of those shares on the date they vest, which also becomes the cost base from a CGT perspective. So if you're going to keep the shares, you might want to think about, do you transfer those shares, do an off-market transfer? Now, if your spouse, for example, is in a much lower sort of tax position, lower income, maybe you're better off transferring the shares into your spouse's name at that particular time when they vest, or even potentially into a family trust or something like that, which is what we've done with some clients where they've got other investments in a family trust. Let's move those shares and we'll gradually divest of them over time. It gives us some flexibility around distributing future capital gains as well. Also, if the shares drop within 30 days, drop significantly within 30 days of investing, think about potentially changing the ownership during that period of time. So for example, if my shares vested at $5 and 2 weeks later they drop to $3, well, then I'll think about where can I off-market sell these shares to. So can I sell them into my family trust, or can I sell them to my spouse, for example? Because of course, remember the taxing point is either market value at the time of investing, or if the ownership is transferred, sold within a 30-day period of vesting, then it's that market value. And so if I don't change the ownership, then I'm going to be taxed on, the market value when they vested, which is much higher than what it is today. Now, I just wanted to spend a little bit of time on employee share purchase plans. So this is when employees can use pre-tax salary to buy shares in their employer, often at a discount. As I said, the discount typically ranges between sort of 5 to 15%. So because you can buy them pre-tax, if you spend $5,000 and your tax rate is 39%, that's your marginal tax rate, you've already saved about $2,000 in tax already. Now, if you receive a 10% discount on the shares, as I said, you'll be taxed on that discount. So maybe you got to pay, on that $5,000, maybe $200 worth of tax. So $5,000 worth of shares, of course, that is. And the discount, the discount's about $550. So the market value of the shares is about $5,550 in that 10% discount scenario. And even though you pay $200 tax on the value of the discount, you're still left with $350 worth of value after tax. So really, it's about $2,300 better off if you're on that 39% tax rate. However, the key thing here is, do they vest immediately? Because if they vest immediately, then you would definitely participate in a share purchase plan like this, because I would go and buy the $5,000 worth of shares. You get $5,500 worth of shares. You pay a little bit of tax, and then you go and sell the shares. You're miles better off. But if they don't vest immediately, then you need to really think carefully about having your money tied up in this stock and what the future direction of that stock will be. And if you've got to, say, hold them for 12 months, for instance, well, whilst you might be better off, if the share price really tanks, you might forego any of those tax benefits as a result of that share price coming off. Normally, these employee share purchase plans, they vest straight away. So it's a pretty easy decision in terms of whether to participate. Whether you hold on to the shares is a completely different decision, but I think you'd always participate, even if your intent is just to divest of them as soon as they are allocated to you. Now let's talk about their impact on borrowing capacity. So if you participate in an employee share purchase plan, of course that's voluntary. That won't have any impact on your borrowing capacity. So that is, even if you're salary sacrificing $5,000 a year, most banks are going to add that back to your borrowing capacity. If you are granted shares or options as a result of short or long-term incentive plans, some lenders will include that as income. So some lenders will ask for the vesting schedule, so how these shares will vest over time, and include, maybe 80% of what's going to vest over the next couple of years. And it just depends on, the history, the individual borrower, the strength of the overall borrower, those sorts of things. But we can include these sorts of incentives that are granted to increase borrowing capacity. And typically, some parts of the bank, like private bank, will be more inclined to do so. But even outside sort of private bank, it's still possible. But the real benefit of these share grants really come in the fact of this capital injection. Obviously, it's a capital injection after tax, but this is where I've seen them play a significant role. So, where clients, for example, have had a pretty sizable home loan, they've got a bit of a sign-on bonus, they've got some long-term incentives that have started to vest, they can then go and sell those stocks, sort of crystallize that capital and use it to reduce their home loan, which then creates, a better cash flow position. It creates more equity in property, and we can then use that equity to invest. So yes, it can help your borrowing capacity, and that's really good too. But I think the biggest impact is really, okay, now I've got these stocks. I'm going to go and sell these stocks because that's the decision I made. I don't want to be, put all my eggs in one basket. I've acknowledged the concentration risk. And so now what do I do with the money? That's the key kind of financial planning issue that kind of falls out of these employee share grants. Now, a little word of warning, as always, this is information, not advice. And every share purchase plan can be different. There's always idiosyncrasies related to taxation matters and these sorts of things. So what I've said is correct as a general observation, but you really do need to get some specific advice. Don't just rely on this podcast episode, of course, but hopefully this episode gives you a better understanding of how these things work, whether you were lucky enough to be able to participate in them today, or whether that opportunity comes your way in the future. But if you do know anyone that does participate in employee share schemes, please feel free to, of course, share the episode with them, because it can be a bit of a confusing topic. Okay, let's get into some listener questions. First one is from someone that wants to remain anonymous. They write, firstly, love the podcast. Have been listening for a long time. Got significant value from your content and the way that it's delivered. Thank you. You're most welcome. Question relates to myself and my family. We're moving over to Indonesia to work and become a non-tax non-resident for tax purposes in Australia, but want to ensure we manage cash flow and continue to set ourselves up in the future. We're contracted for 2 years, both teachers, but there is every chance we'll stay abroad for longer. I'll try and summarise our financial position. So 41 and 39, husband and wife, kids are 5 and 9. 3 investment properties, negative cash flow about 30,000. Value 2.4, debt is 1.65. Primary place of residence, 650, no debt, obviously we rent it out. 440,000 in a managed fund portfolio, 270 inside super. Cash flow will be significantly stronger in Indonesia, about $80,000 to $100,000 a year. And this person has asked, do we increase contributions into the managed funds, that put cash in offset account, buy another investment property or something else? And they write that they will plan to upgrade the principal place of residence when they return to Australia, probably spending $1 to $1.2 million. Okay, so there's a couple of issues here. Couple of tax planning issues, so you need to get some personalised advice. The first question is, will the ATO regard you as a non-tax resident? Now remember, if you are an Australian tax resident, you are taxed on your worldwide income and capital gains. If you're a non-resident, you are not. You are only taxed on what's called taxable Australian property, which is really property, residential and commercial property. Of course, the ATO, it's in their favour to regard you as a resident. It is really based on the facts of the case, and it's really based on case law, and it's not very codified, although, the government's been threatening to change the residency rules for a long time. But if you are only on a 2-year contract, you retain your home. The question will be, what will you do with your possessions? If you just go and put them into storage, for example, so your furniture and everything like that, that's not going to work in your favor. If you go and sell everything, and you sell any cars and you relinquish any memberships, if it looks like what's called you are severing ties with Australia and you have no intent, even despite the 2-year contract, no intent to return to Australia, you could argue that you are a non-tax resident. But if it looks like to the ATO that you have not severed ties with Australia, and of course, you've got significant assets, you've got managed investments, you've got 3 investment properties, a home, super. So you're going to have to go to a pretty significant extent potentially to demonstrate you've severed ties. Then you'll be treated as a tax resident. Now, of course, looking at Indonesians' income tax rates, they're obviously lower than what they are in Australia, I think 30%. Or maybe even lower than that. And that's typically the case when people go and work overseas, whether it's Dubai or somewhere else. They're typically going because it's not only do they get paid more than what they'd get paid in Australia, but the taxation is in their favour as well. So it would, from that income perspective, benefit you to make that argument that you are a non-tax resident. However, here's the big thing. If you are a non-tax resident, you cannot claim the main residence exemption for the period of time that you are a non-resident. So you won't be able to claim that main residence exemption for that 2-year period if you're only overseas for 2 years. Now that means that you will have to pay a proportion of capital gains tax on your family home. And also, it gets worse, you are not entitled to the 50% CGT discount for the period of time also that you're a non-resident. So again, it's proportional. So if you own a property for 10 years in total and you're a non-resident for 2 years, that means that, 80% of the gain can be discounted by 50%. You only get a proportionate benefit of that 50% CGT discount. So essentially means, whereas the managed funds, as a non-resident, they're not taxed. So the income will be ignored, and any capital gains on that portfolio won't attract tax. So you're going to need to get some advice to really work out what you're going to do. But as a general rule, when people are non-tax residents, I certainly don't recommend they invest in property, because if you think about it, if we're investing in property, the income is taxable and the full capital gains is taxable. So the full rack, full cost there's no discount, versus ETFs or shares or whatever, there's no tax whatsoever. You don't get the imputation credits, not a big deal, but there's no capital gains tax and no income tax. So when you compare those two assets together, property is just not attractive as a proposition. Now, if you can't really negatively gear as a non-resident, so your property portfolio, you've said, is about 30,000 negative cash flow. The best thing that you can do is only carry forward that loss each year, and you can offset it against income when you eventually do return to Australia. So you're not going to get any immediate tax benefits, but you'll get the tax benefits eventually. And normally when non-residents come back to Australia, they probably don't pay tax for a couple of years because if they've got these built up or accumulated rental losses from their investment properties. But the key thing here is you said you want to upgrade your home from 650 to 1 to 1.2. And if you're only going to be away for 2 years, I know you've said that you might be away for longer, and every client that's gone overseas to work for 2 years has always stayed longer. So if I look at the probabilities you will stay longer. I think what I would do is put cash in offset accounts. So I wouldn't make any further investments, not unless the market really dropped. Instead, I'd put money in offset account, because what you want to do is reduce your negative gearing, because you're not going to get a tax benefit, at least not immediately. And then it'll allow you to build up cash against that debt portfolio to help you upgrade the home down the track. And if the market really tanked, well, then maybe you think about taking some of that money out of offset and putting it in your share portfolio or managed fund portfolio, whatever it is. That's probably just generally the view that I'd take, but I'd really want to form a view on whether we want to make the argument that you are a resident or non-resident. And in that regard, it is probably worthwhile getting a private ruling as well from the ATO, at least for the first tax year. Okay, I'm well and truly over today. Apologies for that. Hope you enjoyed today's episode, and until next week, bye for now. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel, and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it, because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.